David, we get a fair amount of reader email asking us to talk about counting versus accounting when it comes to non-cash gifts.
All right, so let's talk about counting and how we count non-cash or our estate gifts. So the first thing we have to really do is put into place our policies. And I always say to the charity who's asking that question, hey, can we count this? What is your policy? And hopefully you have policies, and we get guidance. I mean, there are no real policies or whatever you want to put in there, but there's guidance. University, they have an organization called CASE. CASE has basically a proposed guidelines for counting various gifts, cash, stock, how you do it, estate gifts, etc. The National Plan Giving Council also has guidelines that you can use. They differ a little bit. One's a little bit more generous than the other, but they're guidelines. And that's all they are. But what you really need to do is take a look at those guidelines and put in place what will your policy be. So for example, for counting purposes, I get an estate gift. Somebody says, I've left you in my will $1 million. And they give you the number. Now the first question, is it revocable? Is it irrevocable? Can we count that? Can I put that in my totals? Well, that depends on your policy. So under CASE, you can count, and actually under both policies, you can count revocable gifts certain ways. The second question is, at what value am I going to put that on the books for the purposes of telling the world, hey, we had $1 million gift. There's other factors that come into guys. How old's the individual? So if the individual's 25 years old, am I going to be able to count that? So the guidelines propose that, hey, somebody between the ages of 60 and 70, maybe you do net present value. Over 70, you can count it at full value. There's all kinds of guidelines out there. What did your organization choose? What's comfortable for you? So let's suppose that the person's 80 years old and says, I'm leaving you $1 million in my will. You have a pretty good idea what their assets are, and it's time to book the gift on your books, i.e. the counting books.
The fundraising shop.
The fundraising side of the equation, which yes. I consider the counting. Sometimes you're going to take a look at that and say, okay, well, his assets are X, Y, and Z. He's 80 years old, and I know he's living off those assets for the next, 15 years, perhaps. So will he really have $1 million, when we expect him to pass away or when, the time comes? And the answer may be no. He's got everything in one stock, Cisco, and maybe he's not doing so well. So I may not put on the book the full $1 million from the counting. So you have some leeway as to what you do. Same with real estate. What value do you put real estate on? What value do you value a closely held business? So from the counting side, it's based on an appraisal, not so much on the estates, but if somebody's donating a house, somebody's donating a closely held business, all planned gifts are part of the planned giving sphere. Mm-hmm. How do I value that? And the IRS sets up guidelines as to the appraisals you need to get and who can be an appraisal and how they have to be done. So you can use an appraised value. Now that's counting. And we always like to count and put the number as high as we can because we have goals to hit. And so if I can go to the management and say, hey, I did that $10 million campaign, 30% of it are estates that I've put in there for, $3 million. I've got to be able to say it with a straight face. That's the counting side. There's the accounting side. And the accounting side are the financial books of the organization. So little things, for example, an estate gift. I can count and include an estate gift when I announce, hey, I raised $10 million. An estate gift will not show up on the accounting side of the business unless it's an irrevocable trust of some sort where it's definitely, put in that you're it, they can't change it. You get a statement each year. You do a net present value. There are sometimes you'll put it on the accounting side. For example, real estate. You get an appraisal at $750,000, let's say. I'll put that on the accounting side. The appraisal's good. It looks okay. It's from a legitimate firm. It follows the IRS standards. So I can announce I have a piece of property. I have $750,000 worth of value. That's what I'm going to announce that I raised this year.
Okay, David, let's distinguish between the donor's appraisal and our appraisal, the organization's appraisal.
Right. So a lot of times when you're working with assets such as closely held business, real estate, the factor that we need to take into consideration is really what's the marketability. And yes, the donor's appraisal has that, but the donor's trying to get the value as high as they can. And that's okay because they want the deduction, and we understand that. And as long as they're following the IRS guidelines, and they have the appraiser that's proper under IRS and all the rules that the IRS prescribes, they can defend that to the IRS and take that deduction. But on the other hand, internally, we may say, hey, we're worried we may have to hold this for a couple of years, or maybe we want an appraisal that shows what can we do, sell it at a quicker sale than holding it for a year or two. And we may get an appraisal, or even just an independent appraisal we go out and get that shows the property is only worth $600,000 instead of $700,000. So from a management standpoint, your internal accounting department may decide we're not going to book it on the books of the organization for $700. We're only going to book it for $600, or they could actually book it for less, taking into other considerations. It's the same with an estate. If I know that an individual is only 70 years old with $1 million, and that's what he's leaving us, he's going to use up some of that money. I may not put it even on the fundraising books at $1 million. I may say to him, look, you're 70 years old. We just don't feel comfortable putting it here. We'll recognize you in the club at that amount, but we're going to put it in our books for a little bit less. So you do have some leeway there. The accounting side, not so much. I mean, it really has to follow the GAAP accounting rules and take into consideration things that we don't necessarily have to take into consideration when we're doing our books. So, for example, we book the estate gift on our books, i.e. the fundraising books. It never shows up on the accounting books until that person dies. And then what's realized is what shows up on the accounting books. So there is a difference between the accounting books and the fundraising books. And sometimes we confuse that. And sometimes the accounting department says you can't book that gift, but yet the guidelines say you can, or they'll say, hey, we only will book it if it's irrevocable. Again, that's a choice that an organization can make, even though guidelines that are out there say, hey, take a look at a revocable. You can book a revocable gift properly. There's ways of doing that, and we can announce that in our campaign totals and our totals. So that's kind of a little bit of the confusion. But now, since we're on appraisals, I do want to point out one thing, because I get this asked a lot, and you probably get this asked a lot. Is it okay for the charity to get an appraisal? Is a requirement that the donor has to get the appraisal? Now, the reality is the appraisal is supposed to be done by an impartial party. And a lot of times a charity says, oh, we'll pay for it when the donor says they're not going to. So let's take a look at that gift intent to begin with. Are they really, what are they trying to do? And should the charity actually do that? And the answer is no. Not so much because the IRS says you can't. But let's suppose I go out and I pay for an appraisal as a charity, and the appraisal says the property is worth $750,000. The donor then uses that appraisal to set up the IRS deduction. All right, here's my appraisal, here's the deduction. The IRS challenges it, and the donor ends up losing in court, and it turns out that the appraisal should have said, $650,000 or $300,000 or whatever it should have said. Who's the donor mad at this point? Now they're paying penalties, interest, and additional taxes. We paid for the charity. We paid for that appraisal. Who are they mad with? Us. And I've actually seen situations where the donor was so mad that he turned around and sued the charity because the appraisal was bad that the charity paid for on his behalf. So it's never a good policy to have a charity pay for the appraisal that a donor should have when booking. So the takeaway here is the books, the accounting books, and the counting books, or the fundraising numbers, are two different sets of books governed by different guidelines. To put a policy in place that says this is how we count it, this is when we count it, and this is the value we will count it at, or here are the parameters of the value we will count it at. And that way you're not looking at every gift and saying, should I count it, should I not count it, what do I do? And pick up the phone call, and although I love the phone call because people are paying me to give the answer, put the policy together, and we can help you do that. Have that in place. And then lastly, not really counting or accounting, but the little tip, never pay for an appraisal on a gift that's being given to the charity. It's like no good deed remains unpunished.
Yes.
It will always bite you. So.
Good stuff. Thank you, David. For more good stuff, check us out, giftplanningdevelopment.com, if you'd like to talk to us about us helping you get your policies in place, get the infrastructure and strategy and process in place to build a sustainable plan giving program. Please give us a call, 610-653-7906. or send us an email, info@giftplanningdevelopment.com.
I'm David Toll.
And I'm Joe Tumalo.
Till next time.
Until next time.